This video, I wanted to cover creating a diversified stock portfolio and just cover some principles that I would want investors, especially younger investors, to get their heads around. As I host live streams and publish videos and get feedback, I realize that investors are looking for maybe some lessons on how to construct a good portfolio, how to build wealth, and how to really have a good life plan around their finances. So I hope that this video just gives you a couple good ideas on some future road mapping you can do for your portfolio. Now, why is diversifying your stock portfolio important? First, risk. The current market, we're seeing a sell off in stocks, and it probably isn't fun if you're just in one stock and that stock's really selling off. Maybe it's sold off 25% year to date here in 2025. That is not fun. So when you diversify, you're really balancing out risk, and you're maybe one stock's going down while two are going up. Well, you're still happy because you're making money. Or maybe a part of your portfolio is underperforming while part of your portfolio is doing all right. That's what diversification is all about. And having a good portfolio manages risk. It really helps you to keep growing your wealth. At the same time, you can still invest in individual stocks that you really believe in. So diversifying your portfolio is really important, or I would say a benefit to you overall. And it's really followed by just about every investor. Some investors believe that you should concentrate your positions in a few stocks. I get that. Some investors over diversify. I get that too. I'm probably uh, in the middle, but maybe toward owning more stocks. I just like to diversify and I enjoy investing. So let me go through a couple of different topics that I hope you find interesting. Build a stock portfolio that really is focused on you, and really the goals that you have out of your portfolio. Is it to grow your wealth? You start with maybe a couple $100,000 and you want to get to a couple $1 million. Okay, that's great. How much money can you put in on a monthly basis? And what types of risks do you want to take? Are you a type of person that enjoys really doing difficult things and taking on uh, risky engagements, or are you more conservative and would rather grow slowly but make sure you grow? All those things are really important as you make decisions on what types of stocks you're going to own, how many stocks you're going to own, and how much cash and bonds and so forth you're going to own. So really, it's a strong focus on you. One thing that I would encourage you to consider is oftentimes there's a cookie cutter approach, like, hey, let me go see what somebody else is doing and I'll copy that. And I think at the beginning, or at any time really, seeing what other investors do, especially super investors, you can learn something from it. But I wouldn't copy it just completely. And they probably have a different set of objectives that they have and different goals, and it doesn't line up with you. So I would say that looking at what other super investors are doing is a really productive exercise. Hey, how do they diversify? How are they managing their stock portfolio? Those are really good questions to answer. But just to copy it would be, I think, a bad idea. Instead, I would try to understand, well, what are the lessons learned from that, and then focus on you. What is it that you are going to need? How many stocks can you master and really get good at? And you can always, buy a solid couple of ETFs and you're good to go, and then add stocks over time. So really, I just want it to be centered around what you want and really building towards what you would like to have out of this stock portfolio. So you've gotten your goals down and you have a good journey in mind on your stock portfolio. Now, which stocks should you pick? Well, I really encourage you to pick stocks that belong to sectors and industries that are, first, very desirable, are profitable, they're growing, they create really good free cash flow. And they're sectors and industries and companies that you can really understand. If you can master a few industries, a few sectors, you'll know when to buy, when to hold, when to sell. And over time, you'll just get better at it. You'll know, at this point, I can enter and I can exit. You'll understand that, hey, if I see a company that really resembles a company that I made a lot of money on, I could invest in it and make a lot of money. That really mastery is if you really focus on, again, industries and sectors that are, first, very desirable, and industries and sectors that you can personally master. You can really understand them. You understand how those businesses function. You understand the economy and how it's going to impact that sector. So you know when to get in and get out. And that's really important. Oftentimes you see portfolios and you know you should never invest in a company you don't understand because it's going to surprise you and voila, you lost money. Or maybe you made money, you don't understand why. But if you invest in a company you really understand, you're going to understand why you made money. And then you can go use that lesson to go find other businesses and you can make more money. So you're just compounding your knowledge. And that's really, really exciting. So pick things that are very desirable, that you can really understand and you can master. You will oftentimes hear me say that there are thousands of companies available for us to invest in, and I get to pick the very best ones. And remember that there's a big difference between the profitability between Apple, as an example, and McDonald's. Those are two different, businesses. Apple is incredibly profitable. You make tremendous free cash flow, and the stock is the most valuable stock in the stock market. McDonald's is very well known. I mean, we've all had a cheeseburger at McDonald's, very easy to understand, but it's not anywhere near as profitable as Apple. So I'd rather pick stocks that resemble Apple and maybe pick a small one that will eventually be a big company that has great profits, great cash flows, and appreciates, rewards investors by stock appreciation. So that's one important lesson or item is really pick the best, pick the most valuable, pick the most desirable that you can in stocks, industries, and sectors. The stock market over the last 6 trading sessions has really sold off, and the volatility is pretty intense. And we're just beginning potentially a good correction and potentially a good crash in the stock market. So I think the reality that some stocks have lost a lot of money is really fresh on our minds. So being in cash, bonds, or something that's non-stocks in a portfolio, a stock portfolio, is a good idea for a couple reasons. First, if you keep cash or bonds that you can liquidate, maybe a bond ETF, you can take advantage of stocks when they sell off. Let's say we're in a correction at the current time and stocks keep selling off and we find ourselves maybe at the middle of 2025 and stock prices are really low priced. Well, that cash is looking real good because you could buy these great businesses for a very good price and you can make lots of money over time. And that cash right now is earning 4%. That isn't bad, especially in a down market. It looks pretty darn good. So having a bit of cash, and depending on age, your cash level might be a little different. If you're young, you're making good money. Maybe you're in your 30s and you're beginning to make some really good money, and you're able to put in sizable chunks of your income into your portfolio. That's great. You can probably carry a lower cash balance because you're making money, you're earning money, you're in your 30s, 40s, maybe 50s, and you're putting a lot of money into your portfolio. Maybe if you're retired and have stopped working and you don't have any more inflows, then maybe you carry a little extra cash and maybe you have more bonds because you really want your living expenses to be covered by your portfolio. Understandable. And you can really take advantage of market corrections as well, which is in my journey as an investor, taking advantage of corrections has been some of the most profitable periods of my portfolio. I've made great money on every market crash. You don't make it at the moment when the market crashes, but you make it in the following 5 to 10 years. You make tremendous amounts. So remember that cash and bonds is a good thing. There are oftentimes some expressions that you should always be invested at all times. And I think they're referring to, don't completely get out of stocks and try to time the market completely. But that doesn't mean you shouldn't diversify and have some cash reserves out there or some bonds. Bonds and cash obviously are much lower risk than stocks, and it's good to have a balance of those in a portfolio. Now that you've done all that work, you want to be sure that you are on the right track, and reviewing your performance and seeing how you did at the end of each month is a good idea. at the end of each quarter and the end of each year, just to see that you are on the right path and you're going to create great wealth for yourself and empower yourself financially. So looking at your portfolio and seeing how you're performing, understanding, the stocks that you're buying, should they be going up or down? Compare against the market and see the market's going up and you're going up. Great. Now, understand that even great investors like Warren Buffett do not beat the S&P every year. In fact, in the last 10 years, Warren Buffett only beat the market 5 out of 10 times. And on some years, he really missed. I mean, he was way off. He really underperformed the market. Yet Warren Buffett made tremendous amounts of money and built very high wealth. The point being is you do not need to be perfect to make a lot of money. But if you continue to learn over time, you're going to become better and better and make more and more money. So don't overreact if you have a bad month, a bad year. Try to learn, try to use that as an investment in becoming a better investor. But I think looking at your performance and seeing how things play out is really important. Understand when you should be selling stocks. And that's one thing that has been more difficult, I've found, is to sell stocks. It's far easier to find a company that I think is discounted, buy into it. But if it's underperforming, I find it hard to sell it. And I think you need to exercise that every once in a while just to become better at exiting a bad position. And the other thing is selling a winner. Even the great Warren Buffett again has sold out of some winners. And he is a person that would tell everyone that winners will forever blossom. That's his term, meaning that the compounding that happens when you own a stock for a long period of time is tremendous, but it has its limitations. In the case of Warren Buffett, the Apple investment was brilliant, but he's really sold a lot of shares, showing that even the great Warren Buffett is going to exit a winner at some point. So learning when to sell is really important. I think if you are managing your portfolio and looking at the performance closely, it gives you a bird's eye view of where your stocks are at. You continue to reanalyze companies you own and set an exit plan on particular stocks, really managing that performance. Investing in stocks is incredibly difficult, but it could be very, very profitable and lucrative and empowering and satisfying. And I would encourage you to think about the struggle. And if you're the type of person that really, through your experiences in life, you really like having something in your life that's really, really tough, whether it be a subject you need to learn, you love doing really difficult chemistry or mathematics, or you're a mountaineer and you like climbing really, really tall mountains, whatever that is. Um, Stock investing, I would encourage you to really embrace the struggle. And the struggle is real. It's really, really tough. Uh, Hundreds of millions of investors around the world are trying to make money on stocks. And I think it's an acquired taste and it could be really, really gratifying. But it is a struggle. Sometimes the market will knock us on our backs and we need to dust ourselves off and continue to move on. Look at what you've accomplished over time. I have the benefit of looking back 30 years and seeing that, hey, I started with pretty much nothing and I've amassed a good balance of wealth. And that is the struggle that I encourage you to really embrace, is just understand that this is tough, but it's worth it. Um, People that decide to, scale Mount Everest as an example, they don't do it because it's easy. They do it because it's incredibly challenging and they want to have the sense of accomplishing that particular goal, and the experience of doing so, being one of the few that scale up Mount Everest, is probably something that they're very proud of. And that's what I'm talking about there, is embrace the struggle because it is going to be tough, but it is going to be worth it. So those are my comments overall on creating a diversified stock portfolio. This video is really aimed at the viewers of my channel. And I thought about this video really by processing the questions that I get asked. And it's probably more toward the younger investor. I'm really glad to see a lot of young investors are on my channel because you're really investing in yourself. And over time, you're just going to keep getting better. You're going to keep getting wealthier. and that's great. The younger you start, the better. But I also see a lot of older investors, and that's great too. And you guys probably understand a lot of the things that I just covered. So maybe it's just a reminder. And of course, I'm always open to comments on this. And I hope you appreciate and enjoy the video. Thank you for watching.